Hello, and welcome to the Business Behind Small Business, the show that reminds you that just because you own a business doesn't mean you're a business owner. In each episode, we will discuss a common issue small businesses face and offer tips and advice from the perspectives of two business owners, one that built to sell and one that built to inherit. We are your hosts, Sevana Stone and Chloe Lee. There's a lot of business behind small business, so let's get to it. Your business is in financial crisis. Or is it? How would you know? Today we will discuss red flags on your financial statement and what to look for. But before we do, we have some housekeeping to do. Before we begin, we should note our disclaimer. We are not licensed financial experts, nor do we give financial advice. Anything we share with you here on our podcast, whether it be a personal experience or submission, or advice, tips that have worked for us, or that we believe would work for you, should not be viewed as either financial, business, or tax advice. We ask for you to do your research, have open and honest conversations with your company's own support providers, and make decisions based upon that. Throughout this broadcast, we will share our knowledge and give suggestions and hope you will receive them as part of your overall research to better your own company. All right, so before we get into identifying red flags, we should first explore what the basic roles are of a CPA, accountant, bookkeeper, and financial advisor. The reason being, they will all have a touch on your profit and loss report, and to be honest, I feel like I have more conversations than not with business owners who don't actually know the difference, especially between an accountant, a bookkeeper, and a CPA. If you hear any terms of which you do not understand, please take a listen to our podcast, which shares the basic definitions of important bookkeeping terms. So, Chloe, would you please tell our listeners what the difference is between all of the above?
Thank you, Sevana. So this is important because oftentimes not knowing what somebody's role is and what their expertise are can kind of get you in a little bit of a tailspin, right? Because everybody has different levels of specialties and what they focus on. So if you are, let's just say, expecting financial reports from at the level of a CPA from your bookkeeper, that's really just unfair to your bookkeeper. So it's good to know kind of what everybody does and what they're really good at, and that way you can figure out what's the best hire for your company. So let's start with a bookkeeper. So bookkeepers are really important, actually. They're the ones that are actually at the front of the line who kind of enters data into your books, and they focus on pretty much the transactional data. They also do things like produce your invoices, they may enter your bills, and they make sure that all the ins and outs of your bank and credit card accounts are all recorded on your books. Most importantly, they kind of help you categorize all your transactions into different accounts. And oftentimes, they will also generate like simple financial reports, such as the balance sheet and profit and loss, to provide to their business owners so they can see how the business is doing. So there is also accountants. So there are usually two types of accountants. There are accountants who are tax accountants and accountants who are financial accounts. Anybody who is an accountant will likely know the difference, because oftentimes if you're a financial accountant, most people will see you and then ask you, hey, can you do my taxes? And you're looking at them like, no, that's not what I do. So financial accounts usually take what bookkeepers enter into the books and make sure that the financial reports actually reflect the story of the company. So they do this by adding on to what the bookkeepers have done. So they may do adjusting entries, they may apply certain accounting principles, and they'll analyze your accounts. They're there to really make sure that your information is not only accurate, but it's actually meaningful. And then most importantly, it's provided to you on a timely basis. So a CPA is an accountant who's received a certification by passing the CPA exam, obtained a required level of education and experience. I don't know, Sevana, if you have anything to say about CPAs versus accountants.
So I always try to tell either potential clients or clients so that they can better understand it in their own terms. The difference between the three to me is like a nurse, a doctor and a surgeon, I feel like the nurse has to take all of your vitals, and they're the first person that you see. They're the ones that know you the most intimately. And sometimes when you go to the doctor, you see the nurse more than you see anyone else. But that nurse's information, your blood pressure, your breathing, all of the vital things, they give it to the doctor. Doctor reads it and then asks you some more questions, right? They talk to you about what your problems might be, maybe even put together a preventative care plan for you or whatever it may be. But then they'll be like, okay, you know what? I really think you need to go to a surgeon for this, or you need to go to a specialist for this. And that's, to me, is where the CPA gets involved. They take the information that the nurse collected and then the information that the doctor collected and then help you make overall health decisions. So that's kind of how I describe it to my clients, and then they're like, oh yeah, now I get it. I'm like, that's why an accountant, or rather that's why I say, like, a bookkeeper, an accountant can be a bookkeeper.
Correct.
An accountant can be a CPA, but a CPA can be an accountant. But in order for an accountant to be a CPA, they have to get a special certification for that.
Yeah, you got it. I mean, I think where it gets really confusing is because, you can be an accountant and do both accounting and bookkeeping task, right? I mean, if anything, everybody has to be a bookkeeper at some level. Every company needs a bookkeeper. So there is somebody that has to be in the front of the line, like you said, with the nurse taking all the basic intake of information and making sure that at least preliminarily it's all in the right places and organized for like an accountant to come in and maybe do some higher level work on top of that to get it to a not usable, because it's usable when a bookkeeper gets to it, but to get it to a meaningful report for a business owner, or in your case a patient, to be able to digest the information. And so I think that's where it gets really confusing, is because, like you said, a accountant can be a bookkeeper, but for an accountant to be a CPA, they have to pass certification.
Right.
So that means a CPA can be both an accountant and a bookkeeper.
Right.
Confusing, right?
Totally. And in my company, that's why I say that we do bookkeeping and accounting, because of that very reason. Sometimes some clients just need basic bookkeeping, but then we have clients who need, cash flow analyses, budgeting, budget reports, AP and AR reports. It starts to get a little bit more complicated and multi-layered. And the higher up you go, the more multi-layered it gets. And I added the financial advisor in here because the financial advisor is the last person, or the highest level person, I guess, depending on what tree you're climbing, that sees what the bookkeeper created, what the accountant added to that, what the CPA added to that, and then finally it gets to the financial advisor. So
I would actually just add one more layer in between, because to me, when I think financial advisor, I always think that it's probably I feel like financial advisors are a little bit more individually focused, meaning that in a business, they're probably focused on the wealth and the financial kind of strategy for the business owner specifically, which will take in both the business side and the business owner's personal. So we talk about mortgages, savings, investments, maybe even estate planning along those lines. But in a company, I feel like the highest level, if we're going down that road, would probably be the CFO, if a company has a CFO, right? Because most of the time, the CFO, it's probably not needed until you really get into some substantial level of revenue. And they usually are pretty expensive for all the right reasons. A lot of them have a lot of experience. And they are very different than accountants and bookkeepers. So CFOs they will take the information that bookkeepers and accountants put together, and they will actually use that information to do financial analysis, projections, and models that kind of helps meet the company's financial goals. Whereas I think financial advisor takes a little bit of the business, but mostly their focus is on the business owner's financial goals and growth. I like to think of it as the fact that, and just to make it even more confusing, not all CFOs are CPAs. And they'll be the first ones to tell you that. There are some who are, but a lot of times they're not. And just because the expertise is a little bit different, and it just requires a different set of experiences for a CFO. But I do like to think about how a accountants and bookkeepers tend to focus on like what was and what is in your company because they're looking at like historical information, things that have already occurred. And then I feel like CFOs tend to focus on the future and what's to come and how to use your financial information today to kind of help you, project into the future and what you're going to do then.
And in order to do that, what is it that they need to look at? What are the reports or what are the statements that they need to take a look at?
So absolutely the balance sheet, the income statement, and then the cash flow statement. Usually like having year-over-year trends are definitely helpful, especially when you can kind of spot and see patterns. But really these three financials are at the very basics, what every business owner should be looking at.
Cool. So I am now going to give some ideas on what you should be looking at. What are some red flags in your statements? The first I'd like to review is rising debt to equity ratio.
You started with the hard one.
I did. This is like
just get right into it.
I know. It's funny because I can say that these are not words that most people understand. I feel like, what was his name? From the movie with Jackie Chan. Like, do you understand the words that are coming out of my mouth? I'm like, no, I don't understand. Yeah. Don't understand.
It might be a challenge to try to figure out what sentence to put in the words rising debt to equity ratio. If you ever have to use that in one sentence.
I know, such sexy words. Okay, so your business's debt ratio is an indicator of the stability of your business, right? And it also it's very telling as to whether or not your company is one that someone else or another company or whomever with money in their hands should invest in or should loan to. Now, when I say to loan to, that includes your bank, because at some point you may want or need a bank loan. You may want or need investors. And if you need to know what your debt to equity ratio is. So to calculate this, you're going to divide the company's total liabilities by shareholder equity. The numbers here are available on the balance sheet of your company's financial statements. Next would be the increase in inventory. Remember now, these are all red flags that you're looking for. You need to look to see if there's an increase in inventory. So if your company sells inventory, you're selling products. But if you have products that are sitting and not selling, you're losing money. The way you identify this is by calculating the average inventory for the year, and then you divide the average inventory by this year's sales. So this is actually very important. I had a client, just to segue for a moment, I had a client who couldn't understand why their business, their sales were skyrocketing, and yet somehow they were sinking deeper and deeper into debt. And what was happening is that there were products that were being made and just sitting there. And because they were fresh products, there was a disconnect between he and the supplier. And the supplier, because they had an end date or an expiration date, they were having to throw these things out that the client had already paid for.
Oh, wow. Okay.
Yeah, and so they were losing money.
They're probably losing a lot of cash too if they weren't moving their inventory.
They were making a lot of money, but they were losing even more money than they were making. And so we had to help them try and figure out how to make that stop. But they wouldn't have known that if they hadn't looked specifically for an increase in their inventory. So also rising accounts receivable. If your accounts receivable is going up, then you're not generating a return. It's important to have enough inventory for orders, but your business isn't going to want to have a significant portion of it sitting unsold or money being owed. This also might be an indicator that you're not being effective at collecting money. Maybe it comes difficult to you to ask for people to pay up, but this is what your business is based on. So, it's important to have a good process for this. So how do you find out what your rising accounts receivable actually is? So identify it by dividing the average accounts receivable balance by annual sales. If the ratio is higher than in previous years, your receivables are creeping up.
And this is an interesting one too, because if you have a rise in your accounts receivable, most often you probably have a rise in your revenue. So if you're not understanding and you're not looking at your balance sheet and all you're looking at is just your profit and loss or income, then then you're thinking that, oh, you're doing great because your revenue keeps going up. But to be quite honest, if you're not collecting on that revenue, that means you're not getting cash in the bank.
Yes, absolutely. Another massive red flag is fixed assets. Do you don't want or need a fixed asset anymore? That's fine. Just don't sell it to pay down a debt for quick cash. You have to identify these on your balance sheet. Gains and losses from fixed assets are noted on your income statement, and disposals are apparent on the balance sheet. And lastly, unsteady cash flow. This is a big one. This is a very common one.
Right.
Your numbers aren't having fun without you. It's concerning when your cash flow goes up and down and not back and forth. If the net cash flow is low year after year compared to net income, you're getting ready to experience a cash crunch.
Yeah, and I think that's where the third statement we had talked about, the statement of cash flow, is probably the least understood.
Yes.
And it's probably a report most people don't really even think to look at. But as you get into a sizable business, and if you go to the bank or you go to investors, they will ask you for this because that report will show where you spent all your money at. And if you see a lot of ups and downs, or in your case, not going back and forth but going up and down, whichever direction you're going, if it's not steady, you're right. You eventually get into a cash crunch. So let's talk about what is on your income statement. There are a few indicators in income statement that could also be red flags if you know what you're looking for. So let's just jump into the biggest one, which is a decreasing profit margin. So your profit margin is the core to your success. Now, I know that everybody wants to just look at what their top line revenue is because that number is pretty and good to look at, especially when it's high and has a lot of
my
columns.
favorite number.
It feels good, but if you're not managing your profit margin, it may look great on top and terrible on the bottom. If your profit margin is steadily decreasing, I mean, that could be the beginning of the end of your business. You probably heard of a couple different types of profit margins. There's the gross profit margin and then the net profit margin. Tracking both will actually give you a really good metric to measure your business by. Far better than just looking at your top line revenue. So gross profit margin is your total revenue less the cost to produce your product or service. Sometimes that's referred to as your cost of goods sold or cost of services sold. And your net profit margin is your total revenue less your total expense. So that includes your cost of goods sold and all operating costs to, keep your business running. This is what most people refer to when they say your bottom line. Is your this is where you can calculate your net profit margin. So to do that, calculate the net profit by dividing the net profit by total sales for a given accounting period, and then multiply that figure by 100 to get a percentage. So for example, if a company has a net profit of 1,000 and the total sales of 10,000, that'll give you a net profit margin of 10%. Every business and every industry is a little bit different, so finding what the right profit margin will kind of vary, but there are industry standards out there, and it'll be a good way of really honing in on how well your business is doing. All right, so a couple other things. Let's talk about good debt. So all business have debt, and some businesses take on debt to get a better rate of return. So the leverage of borrow funds created allows investors to have a greater return on their money, and this is a really good thing. Now let's talk about bad debt. Having debt ratio higher than 1 doesn't mean that a business has too much debt or has made any bad financial decisions. In fact, it means that you rely more heavily on debt than other companies with lower debt ratios. So I think a lot of this has to do with kind of your appetite for risk. There are certainly business owners who, love debt because they can manage it well. And so they're using debt to kind of grow their business faster. And then there are others, which I can say from personal experience, I'm, from the school of cash, apparently, growing up, knowing that you should never take on debt and you should always pay everything off in cash. I have very little debt on my books because I don't like being leveraged that way. But I will say that it is a much slower way to grow your business organically than it is to have, debt that you know how to leverage well. Also, look for a history of trending down revenue. If you're looking at your financial statements from this or 2 years ago, you should see that your gross profit is actually going up. So if you see that going the opposite direction, then that's also a good indicator. You may have some issues that is coming up in the future. The other red flag is consistently higher liabilities than assets. So some companies, like those in construction, has seasons and cycles. So a company may, may have to plan around like leaner months, where there's certain months that are just a little bit slower than others. If a company is consistently assuming more liability without a proportional increase in their assets, that's also a sign that the business may be over leveraged. So keeping an eye on how your liabilities measure up against your assets will be also a good indicator of the health of your business. So we have 2 items left here to discuss, and one of them is non-operating income. If you have investors and creditors, meaning also your bank, if you're trying to get a loan, they like to see consistent income. I think all of us as business owners do. That's why the subscription model of services is so popular these days, because it gives you consistent income. But it's nice to know that you have that money coming in. Usually creditors, investors are a little wary of income from like really large sales, like in a form of like a fixed asset or gains from the sale or sale of a fixed asset. They also don't like it when it's from like sales of investments. So a lot of these are considered what they call non-operating income, which may actually skew your net profit margin at the end of the day. Let's talk about the flip side of that, which is other expenses. So other expenses are usually, sometimes you'll see these. I think these are accountants' favorite account names, miscellaneous expense, other expense, which is a catch-all for basically anything and everything. But the problem with that is if somebody looks at your financials and they see a huge expense line there, one, they're going to question what the heck have you been spending on, and two, it just doesn't look that good, especially if it keeps reoccurring and they're looking at a month over month trend and they see this kind of growing line of miscellaneous costs that's showing up on your financials. So what's best is that you probably want to understand what's in this account, and if you can, try to stay away from any accounts called miscellaneous expense or other expense. And or
uncategorized.
Oh, uncategorized expense. Yes, that's the one that's also quite popular.
Ask my accountant.
Ask my accountant. Yes, I think that's on QuickBooks, right?
Yes, it is.
Auto-generated Ask My Accountant that just kind of stays on the books month after month.
Yeah. Yeah, you need to clean that one out. There can't be that many transactions that you have no idea what they are. Yeah, and I know that this is a lot to take on, but these are very important so that you can, first off, know what you're looking at. That's why we coupled these, not necessarily coupled, but we did these podcasts kind of back to back so that, in the one, you're learning terms, and then when we do, by us talking about this, hopefully you understand what the terms mean, so that when you're looking at your financials and these things pop out at you, you know why they're popping out at you and what you can do to resolve them so that your business does stay in good health. So in each episode, we like to connect a famous example to our discussion to help you relate our talking points on a more global or well-recognized scale. Sometimes we use exact examples of either famous persons or successful business owners of today or in history. And sometimes we use examples of people who inspire us and have inspired today's discussion. So Chloe, we'll start with you as to who has inspired you as a famous example.
Yeah, I always like a good story of somebody using their I guess know-how and reading the financials. I feel like you're never too small to start either.
Yeah.
So my example is, and this story is certainly credited to an article written by Joshua Kennan on thebalance.com. So Benjamin Graham was really well known in the 1920s. During this time, the whole world was approaching investments like it's like a giant game of roulette. And Graham kind of searched for stocks that were so inexpensive that they were almost completely void of risk. And one of his best known kind of calls on investment was the Northern Pipeline, which is like an oil transportation company managed by the Rockefellers. And so the story behind this is that the stock was trading at $65 a share. But after looking at the company's balance sheet, Graham realized that the company had bond holdings worth $95 a share. So Graham tried to convince management to sell a portfolio, but they refused. And shortly thereafter, he basically waged a proxy war and secured a spot on the board of directors. The company eventually sold his bonds and paid out dividends in the amount of $70 a share. Again, Graham his approach was really unique in a sense that, it sounds like in the 20s was basically, like they said, a game of roulette when you were investing in stocks. But Graham was really smart, and he started looking at the financial reports of all the companies to kind of determine what's a good investment. And so when Graham was 40 years old, he came up with the principle of intrinsic business value, which is a way to kind of value the true worth of a company independent of their stock prices, so investors can make investment decisions. And this actually laid the groundwork for a lot of fundamental valuation techniques that's used in stock analysis today. And Graham's approach was largely based on only looking at the company's balance sheet and income statement. And from that, he's able to tell so much about a company and be able to make investment decisions that I think that goes a long way of, telling us like how much information is in our financial reports and how much information a business owner can get from the financial reports. So all in all, for anybody who haven't heard of Benjamin Graham, which I actually have not before I actually read the article, you probably heard of the young gentleman that really looked up to him and that he mentored by the name of Warren Buffett.
Cool. I wonder if Warren Buffett used Benjamin Graham's. He must have had him in his ear when he was on the board of directors for Coca-Cola during the time when they were going to purchase Pepsi and Coke. Just because I just listened to this.
Yeah, you just heard this.
Pepsi and Coke were having a war over Quaker Oats, and Warren Buffett just did not see the value of buying Quaker Oats for the sake of Gatorade. He was like, we're going to buy Gatorade, but then we're going to be stuck with all this oatmeal and breakfast stuff. What are we going to do with it? And so he kiboshed it all the way to the point of signing a deal with Quaker. He kiboshed it. He was like, no, it's not worth it. It's not worth the money. It's not worth the risk. And so Pepsi, that's how Pepsi ended up buying Quaker Oats.
So it's interesting too, because from what I understand, Warren Buffett, and again, I should do more reading and studying of him because he's an amazing person.
Oh yeah.
But I understand from him like his approach to what company to invest in. Like basics are, of course, look at the financials first, right? Yep. But he knows that there's so much more that goes into a company than just the number. So I think he goes above and beyond what Graham had taught him, and I think he actually looks a lot into like the company management and history, kind of like we're just talking about stuff that's above and beyond what's on the financial reports. But that's kind of his starting point, and that's actually a starting point of most investors when they're looking at stocks and what company to invest in. Like at least the savvy ones know how to read a financial report and quickly can gain like a story about the company just looking at the numbers on your balance sheet, your income statement, and your statement of cash flow.
Oh yeah, and actually that was part of the reason why. I mean, they went into a little bit more detail as to why he decided to not move forward with the purchase, but yeah, that was it. And if anyone wants to hear a little bit more about that, I should credit Business Wars, and it was the Coke versus Pepsi podcast. There's 6 episodes to it, and Business Wars, I love it because everything that you and I talk about are we're talking about the things that are deep in the weeds. Whereas in that podcast, they're talking about the people and why they made the decisions they did, but we're talking about how is it that people get there on a financial journey, not just making decisions based on emotion or based on, let me beat you. These boil down all the way down to the little guy, all the way down to the small businesses. This is what makes or breaks small businesses. Speaking of make or break businesses, there are so many famous companies that have fallen due to money mismanagement. FedEx is probably one of my favorite comeback stories. And I don't know that most people even know that FedEx, or Federal Express at that time, is an incredible comeback story. So it was founded in 1971 by Frederick Smith. He was the son of the founder of the Tuttle House and what is now the Dixie Greyhound lines. So the pretty wealthy family. He attended Yale and proposed the idea behind FedEx in an assignment while he was there, and he got a C.
I know he did not earn a very good grade, but he showed up.
Yeah, right. Like, I'll show you. Anyway, so he went on to the military, and he served 2 tours in Vietnam. He earned a Silver Star, a Bronze Star, and 2 Purple Hearts. That's incredible. That's so impressive. In 1970, he purchased the controlling interest in Arc Aviation Sales, and in 1971, he used $4 million of his own inheritance, and then he raised an additional $91 million to start FedEx. During the first 2 years of business, the company, they grew enormous amounts of debt due to fuel prices, and they were at the edge of bankruptcy.
Yeah, he almost failed.
Yeah, totally, and like really spectacularly, really
Yeah, he got
spectacularly.
really close to that edge.
Yep. Yeah, and the 1970s, especially the mid 70s, were such a volatile time, um, such a volatile time, and yeah. So especially with fuel and how to get fuel. Anyway, so Smith he went to great lengths to keep the company afloat. This is my favorite part. So he was trying to get a very, very important business loan, and it was denied. His company only had $5,000 left. He took that company's last $5,000. He went to Las Vegas and he won $27,000 gambling on blackjack. With that, he was able to cover the company's $24,000 fuel bill to keep FedEx alive just for one more week.
Oh my God, that sounds like a movie drama right there.
I know.
Like,
Why is there not a movie?
Like, I'm gonna bet all of it on this one, like, hand of cards, and hopefully I beat the house. Like, wow.
Yeah. And in that week, things started to turn around, and then it grew and it grew and it grew. And by 1976, FedEx had produced its first profit of $3.6 million. 7 years later, FedEx became the first U.S. company to reach a revenue of $1 billion within 10 years of the startup with no merger or acquisition. They did it all by themselves by not chaining themselves to another company that may have been more or the same level of success. They've been thriving ever since, as we all know, because
we see them everywhere.
FedEx. Yeah, totally.
No, that's a really good story. You gotta wonder, like, because he says during the first couple of years of the business, they were accumulating debt. You wonder, because everybody who starts, it always takes people a couple of years, a few years, even if you're an accountant, like, to really understand how much your numbers can tell you. Like all these like leading indicator or these red flags we were discussing. You got to wonder if they were actually looking at any of that, or they were doing what a lot of people do the first few years, which is just to survive and not even thinking about how you're surviving, which gets you into this pinch of being on the edge of bankruptcy.
Oh yeah, and he definitely turned it around. I mean, it is incredible. I mean, to be honest, he did have a good chunk of money to start with, and he used his connections. He also belonged to the same Skull and Bones, good friends with the Bushes. He belonged to the same society, so he pulled a lot of strings to get that money, and he used his college connections and his societal connections for that. But hey, man, you do you. You did a great job. Thank you for FedEx, because I like FedEx. All right. So with each episode, we like to share either books, tools, apps, platforms, or anything we think is a great next step and connector to our discussion. So if you like our subject matter and want to learn more, you'll have a great place to start. So Chloe, we'll start with you.
Yeah, so I definitely had a book in mind when we were going over this episode. So the book I was thinking about, it's called Simple Numbers, Straight Talk, Big Profits: 4 Keys to Unlock Your Business Potential. And this book is by Greg Crabtree. So Crabtree is actually an accountant, a small business advisor, and actually a pretty well-known speaker. He does a lot of speaking with small businesses and whatnot. And his book was actually written in a way where, even though he is an accountant himself, he wrote it in a way where it's really simple, it gets straight to the point, and has very easy to follow concepts that really helps, that's actually aimed for companies between the startup and the $5 million phase. So he has a lot of practical and useful tips and concepts in there that can be applied for a business within that range to really help you get to the next level.
Cool. Well, I have a book that I am interested in, but I've not read it. But it seems to be very popular, and I think I would like to dive into it. It's called, it's got like the most appropriate name ever.
Yeah, it does.
How to Read and Understand Financial Statements When You Don't Know What You're Looking At by Brian Klein. It's a very short book. It's a short read. And, I don't know. I can't really go into more detail because it just tells you what that is exactly what it is about. But it does go into great detail, and it's great for business owners and every stage of their business, from beginning to selling to investing. I think that there's a lot of great information that you can glean from this book. So I'm looking forward to reading it myself to see what. And I like that in the few pages that I skimmed through, I like that he's very matter of fact about what terms he's using, and to give you an essence of what that that term means, so that you're not just reading the book, you're also learning what these terms mean. And it helps the information stick in your head a little bit better.
Yeah, and sometimes it's just, sometimes people say it a certain way and it clicks with you, and other times people say it and you can listen to it 50 times and it still doesn't sink in with you. So it's always good to have somebody explain it in yet a different way.
Oh,
that
yeah.
can actually help you understand what that means. But I love the title of the book, I have to say.
I wonder how long it took.
I wonder if his publisher is like, these are too many words. You can't put this on the front page, the front cover. We can't fit this on one cover.
It's like, what else how else could you say it, really?
Well, so that's the thing, too. I think with this episode is the quicker, I feel like, as business owners, we learn that there is more than just revenue, expense, and a bottom line.
Yes.
The more we can start managing the business and measuring our success based on, those indicators we had talked about, you'll just, I don't know, I just feel like it's a more effective way of managing your business. I want to read that book too by Brian Klein, to be quite honest. I feel like you can always learn something new. You never know.
Oh yeah, for sure. And I would say, as my final remarks, if you will, I'll say that if you have a good relationship with your bookkeeper or with your CPA or with your accountant, whoever it is that touches your books or touches your company's financials, if you have a good relationship, a good communicative relationship with them, I suggest that you go over these things with them to take a look, because maybe there's something that they've seen and maybe haven't brought up to you before, or maybe there's something that you see that they just didn't happen to notice. It's important for you to just review it with them, or maybe review it by yourself. And if you have a question, reach out to that person. Again, your CPA, your accountant, your bookkeeper, or CFO, whomever it is that has contributes to the growth of your company financially, and have that conversation with them.
Absolutely. Can't agree more with that.
So please join us for our next episode, The Right Way to Spend Your Business's Money. We will dive into commingling accounts and what that means. The right and wrong way to spend the money your company makes. Want to ask a question, leave a comment, or become a sponsor for a future episode of The Business Behind Small Business? Click on the link in the show notes and fill out the form. Until next time, thanks. Bye.